What's going on, guys? Welcome back to the channel. My name is Anfernee McLemore, and in today's video I want to talk about index funds. You see a lot of people when they get started investing, they always seem to ask the question, well, I don't know what to buy. I don't know where to get started with it, and I really just don't want to lose money. So as a pretty avid index fund investor for myself, I wanted to lay out an entire video talking about really my top 5 index fund investments and what they are and why you may want to consider them for yourselves. As always, this video is meant for entertainment purposes only, so let's dive right into it. However, before we get into the number one index fund of this video, I do want to remind you that if you want to support the channel and if you want to get some free money as well, then you can use that public link in the description below, where if you sign up, you will get a free fractional share of a stock, and that stock can be valued all the way up to about $70. So that's a good chance to get some free money and support the channel if you want to do that. And also, before we get into this list, let's talk about what an index fund is in the first place, because I feel I may be getting too ahead of myself to where if you are watching this list, you may be wanting to get started investing and you may not even know what an index fund is in the first place. So usually when I describe what an index fund is, I tend to use this example of you have $1,000 and you want to get started investing. So if you're someone who didn't know that index fund existed, you may put $100 into Apple, you may put another $200 into Amazon, buy some Tesla, buy some Disney, Coca-Cola, Pfizer. Overall, you can split that $1,000 into about 5 or 10 different stocks. And at the end of the day, you may have picked some good stocks or you may not have picked some good stocks. There's really no way of knowing how your portfolio will do. And also, you may be too heavily bought into one industry, whether that's technology, consumer service, or real estate, or any industry like that. You may not have a very balanced portfolio is what I'm trying to say. But this is where index fund comes in. An index fund allows you to invest in broad sectors or even an overall market by splitting up every single company in that economy and packaging it as one security that you can buy for one price. Now, it doesn't always have to be the overall economy. It could be the S&P 500, or it could be specific sectors like technology, like precious metals or oil and gas, but you will still be investing in a broad number of companies for one price. So usually index funds can range about $100 to $200 depending on what you buy. And with that index fund, you will be buying a sliver, a very small slice in the overall economy. So you won't have to worry about whether one company does bad, because if one company does indeed do bad, you will have about 499 to 1,000 other companies propping it up so that your portfolio balance is even and continuously grows over time. And the great things about index fund, if I haven't explained it already, is that it's a great way to conservatively grow your wealth without having to check it every single day. Typically, when you have stock traders or when you have people trying to actively grow their portfolio on a daily basis, they tend to get stressed out on their bad days because they don't know if it will rebound. With index fund, it's much more of a buy and hold strategy. You don't have to worry about whether it goes up and goes down on a particular day, because over time it will increase in value and you will receive interest for the money you invested. However, with that explanation aside, let's get into the list of the top 5 index fund investments that you should make or you should consider making if you are a long-term investor. And the very first index fund is the Fidelity Zero Large Cap Index Fund. Now, this index fund is great for one reason. It has a 0% expense ratio. This means that there aren't any fees for you having the pleasure of investing in this fund. They won't be taking 1% of your money just for you investing with them. And what this fund is exactly is an index fund that tracks the large cap companies in the United States. Now, while this fund states that it doesn't officially track the S&P 500, it does receive returns similar to that of the S&P 500 because it tracks much of the same companies. You will see companies like Amazon, Tesla, Disney, Apple, Microsoft. All of those big companies are within this index fund and is all for a 0 fee. Now, I believe that this fund should be really attractive for beginner investors simply because of that 0 expense ratio part. And also, there's a minimum investment of $1. And because you're with a big company like Fidelity, you don't really have to worry about them going out of business and you losing your initial investment, although that is always considered a risk. So if you're someone with $100 and you're torn between putting that in a savings account or putting that into this index fund, me personally, I would put it into this index fund, because if I put it into a savings account, not only would I not be earning any interest on that money, but I will be losing value over time due to inflation. So I could be earning 7 to 8% with an index fund. In a savings account, I will be losing 2% each year. And with that compounding over time, you can see how the results may be quite different. But if we move on to the second and probably more popular index fund in this list, that is going to be none other than VOO, or the Vanguard S&P 500 Index Fund. Now, I'm pretty sure if you even type in index fund on Google, or if you even look it up in some form or another, you're going to come across VOO VOO in some sense, either recommending it for you or seeing some results of people who have already invested in it. Now, me personally, I don't use VOO for myself because I do have an account with Fidelity, although you can still buy VOO on different third-party brokerages like Robinhood or WeBull or Public if you use the link in the description below and open an account. And VOO is great because it tracks the top biggest 500 companies in the United States, or another word for that is the S&P 500. Now, VOO does have a slightly larger expense ratio, and that is 0.03%, meaning that for every $10,000 you invest into VOO, you will be charged about $3 annually. Now, honestly, this is not a large expense ratio by any means. It's basically saying that you'll be charged 3 pennies for every $1,000 that you invest. So if you start off investing $100, you'll be charged 3/10 of 3 pennies, which is not a lot of money. And the reason why people think VOO is so great is because it's technically supposed to be tracking the biggest and therefore the best performing companies in the United States of America. Some people believe that this is a good way of weeding out some of the lesser performing companies and only focusing your money on the high performing stuff. And my opinion on this is that you can go either way. Obviously, you can go into the S&P 500 index fund route, or you can go into a total market index fund route where you not only get the companies within the S&P 500, but you also get some of the smaller guys that help round out your portfolio. Now, I have in the past invested in some S&P 500 index funds, and I have had some good returns with that. But for my personal sake, I do invest in a total market index funds where the returns are a little bit lower. However, they are a little bit more stable. But as a beginner, you can really choose to invest in either or. And although I said that VOO may be one of the most popular index funds on this list, I do think that this third one may be even more popular than VOO, and that index fund is SPY, or the Spider S&P 500 index fund. Now, when I was getting started investing in my college days, I would put all of my money in SPY. Pretty much every single extra dollar that wasn't going towards debt payments was going into SPY, and this is the exact index fund that I referenced earlier in which I got started on my investing journey with. Now, SPY and VOO are pretty much the same thing, except that SPY does have a much higher expense ratio at 0.09%, meaning that for every $10,000 you invest, you will be paying $9 in expenses every single year. And while you will be paying more for SPY in expenses, the reward you get from SPY that you don't get from VOO is that SPY is just a little bit more accessible to different brokerages than VOO is. If VOO isn't available on Robinhood, on WeBull, or Public, I guarantee you that SPY will 100% be available. And this is because that VOO is directly tied to Vanguard, and I don't think that SPY is directly tied to any particular company. But just like VOO, SPY tracks the S&P 500, meaning that it tracks the top 500 performing companies in the United States of America. I don't think I said this about VOO, but there is a little bit of downside to only investing in an S&P 500 index fund, and that downside is that you don't have any exposure to the international markets. So you will be leaving out companies like Samsung, IKEA, Alibaba, and some of the other big giants that play their part into the international world if you don't consider investing into an international market index fund. However, you do have a lot of diversity, but you will be playing your cards a little bit more risky if you do just continue to invest solely in the S&P 500 index fund. Now, because the first 3 index funds were solely talking about domestic companies, let's get more into some of the lesser broad index funds. Now, 2 of the funds that I invest in myself personally, I'm going to list at 4 and 5, with the first of those funds coming in at number 4 at the Fidelity Total International Index Fund, or FTIHX. Now, as I said, you do expose yourself to more risk by only investing into a domestic index fund, whether it be a total market index fund or a large cap fund or S&P 500 index fund. If you don't have international exposure in your portfolio, then you will be exposing yourself to a higher risk than if you diversify a little bit more out. And the way I diversified into my portfolio, and if you want to consider doing it as well, is by using FTIHX or really any other international index fund in order to diversify your fund away from some American companies. And by getting a total international market index fund, you basically will be exposing yourself to the total market, basically all the big companies outside of America. And that way, if America's economy drowns and starts to perform poorly, you will have a counterbalance lifting that up and hopefully keeping your portfolio afloat. Now, the way I invest in my portfolio is 67% domestic or United States funds and 27% international funds. So I definitely don't have a majority role in international funds, but I do have a large enough stake at about 1/3 of my portfolio in international funds just to take advantage of any growth or any opportunities that there are in that sense. And FTIHX is great because it has a very low expense ratio as well. I believe at below 0.1%, and that way all of my profits are not just going to the managers that are managing the fund. And I keep going back and saying this, but all these funds that I'm referring you today are going to be funds that have a long track record. A lot of these funds aren't the new kid on the block, so if you invest $100 into them, you won't have a high risk of losing money, although the chances of gaining money are never 100%, because you will have millions and even billions of people investing alongside you that will provide you at a level level of insurance just so you know the manager may not completely fail, although that chance is never 100%. And finally, getting to the last index fund of this video, we're going to be talking about a real estate index fund that I love and I have been trying out for the last few months. And that real estate fund is yet another Fidelity fund at FSRNX, or simply the Fidelity Real Estate Index Funds. Now, this fund serves one purpose for me. It is to give myself some direct exposure to the real estate market in the United States without having to buy real estate myself. And my personal plan for this real estate index fund in my portfolio is to build up a position until I have enough to put a down payment on a rental property. And once I do, I will take the money out of that index fund and put that money that was invested in that index fund into a rental property. Now, the reason why I think this would be a good exchange is because I will be taking real estate money already invested in my portfolio and putting it into more real estate. And right now, as I said earlier, my portfolio is 63% domestic stocks, 27% international stocks, and 10% real estate. So once that 10% real estate is to a number where I want to put a down payment on a rental property, I will simply rebalance my portfolio, take that money out, and put that into a actual physical real estate rental property. But that index fund is great as well because it has a low expense ratio and also offers you more of that direct diversification. Now, anytime you start to get into specific industries like this, you are going to be exposing yourself to more risk. So take that with a grain of salt as well. If you are a complete beginner, go with one of those total market index funds and save yourself the stress of having to check your portfolio every single day. You aren't going to be getting rich in 24 hours by investing in index funds, but you are going to be growing your wealth over time and hopefully compounding your dividend payments and interest over time so that 10 years from now you will have much more money than you would have if you started saving your money. However, with that being said, that's all I have for you in today's video. Don't forget to use the public link in the description below, and I'll see you in the next time, guys. Peace.